Congress has authorized trillions of dollars in spending over the last decade, causing the United States debt to nearly triple since 2009. This constant accumulation of debt has repeatedly pushed the Treasury Department against the debt ceiling, the maximum amount of outstanding debt allowed for the government. If this limit is reached and the Treasury Department cannot make payments, there is a risk of defaulting on the debt. And in January 2023, the US hit its debt ceiling of $31.4 trillion, prompting lawmakers to vote to suspend it until January 2025. However, as of today, the national debt has soared to an alarming $34.7 trillion, surpassing the previous ceiling by $3.3 trillion and continuing to grow every second. According to Jim Rickards, best-selling author and investment banker, the debt problem has got so bad that the Federal Reserve is covertly defaulting on its debt by intentionally managing high inflation levels, which devalues the dollar and reduces the worth of each dollar of debt over time. With the national debt reaching unprecedented levels, Rickards warns that the US is heading towards a fiscal crisis. He believes that the current trajectory of excessive borrowing and spending is completely unsustainable and poses a grave threat to the nation's economic stability. In this video, we'll cover the reasons why Rickards is so concerned about the Fed's current management of the US economy and why he believes such dire consequences are imminent. Make sure you watch the full video, as at the end we'll be showing you what you can do to protect yourself against the impending economic disaster. So, let's get started. At the heart of Rickards' concerns lies the record-setting levels of the US government's debt. But how did we get to this point? Well, the government has expenses it needs to cover each year for things such as Social Security, education, highway maintenance, and military equipment. In addition, the government has spent significant sums in recent years to try and stimulate the economy following the global pandemic. The government earns income in the form of federal income tax, but when it spends more than it earns, a budget deficit results. And as you can see, the US government has run a deficit averaging nearly $1 trillion every year since 2001, with the deficit reaching a staggering $3 trillion in 2020. To pay for this deficit, the government borrows money by selling marketable securities such as Treasury bonds. All of these securities pay interest to its investors, which the government must pay. The national debt is the accumulation of this borrowing along with associated interest owed to the investors who purchased these securities. As the federal government experiences recurring deficits, which is common, the national debt grows. While it is not uncommon for governments to borrow money to finance spending, the US national debt has ballooned over the last 40 years or so. In fact, adjusting for inflation, US national debt has increased by over 700%, from $4.2 trillion in 1983 to its current level of $34 trillion. And Rickards points to this ballooning national debt as a ticking time bomb set to detonate. With each passing year, the debt-to-GDP ratio worsens, signaling a country living far beyond its means. As we mentioned earlier, the government spends money on things like Social Security, education, highway maintenance, and military equipment. And as you can see, its budget each year for these expenses is $6.5 trillion. This means that the current level of government debt is over 5 times the size of its annual budget. Not only that, but the $828 billion interest the government must pay on that debt amounts to nearly 13% of its yearly budget, just on servicing its debts. For context, that is almost the same amount as the entire US defense budget, and that interest is increasing minute by minute, meaning the US government must continue to allocate more funds to pay the interest, diverting resources from other essential areas and increasing the risk of a potential default. If you want to stay updated on the latest global financial news and money topics that can help you build your wealthy life, please don't forget to subscribe to the channel. Okay, moving on. So, how does inflation impact all this? Since the 1980s, the US economy has enjoyed many years of low inflation and even deflation. which is prices dropping and otherwise known as negative inflation. But there was always an underlying fear that this low inflation could be more harmful than beneficial. In response, the Federal Reserve took decisive action in 2012 by setting their target rate at 2%, determined to maintain a stable and healthy rate of inflation in the economy. The reason the Fed sets its target rate at 2% and not lower is due to concerns about the risks of deflation. Deflation, or a sustained decrease in the general price level, can lead to falling wages, decreased consumer spending, and postponed investment, which can exacerbate economic downturns. A 2% inflation target provides a cushion against these deflationary pressures. In addition, by targeting 2% inflation, the Fed can effectively manage real interest rates to support sustainable economic growth without unduly suppressing inflation or borrowing. The Fed has successfully kept inflation at or below its target rate for most years since 2012. However, in 2020 and 2021, this changed drastically. To prevent an economic disaster following the coronavirus pandemic, the Fed injected trillions of dollars into the economy. While it helped prevent an immediate collapse, the long-term effects have been significant as inflation has become one of the main economic risks in the US. The US had enjoyed nearly 4 decades of low and stable inflation since experiencing high rates in the 1980s. But after the Fed's efforts to stimulate the economy, inflation rose by 6.8% between November 2020 and November 2021, reaching a peak of 9.1% in June 2022. Although it has since decreased, it is still higher than what has been seen in over a decade and is taking longer to fall than expected. And Rickards has emphasized that inflation acts as a hidden tax on people as it erodes the purchasing power of money over time, impacting individuals' ability to buy goods and services with the same amount of currency. This now begs the question, how do you tackle this inflation problem? Interest rates are the price of borrowing money. When interest rates are low, it's cheaper to borrow money for things like buying a house or starting a business. But when inflation starts to climb, the Fed might decide to raise interest rates. They do this to slow down the speed of price increases, as higher interest rates make it more expensive for people and businesses to borrow money, discouraging consumer spending and discouraging companies from taking on debt to finance expansion. Higher interest rates also make saving more attractive, further reducing consumer spending. And as you can see from this chart, since February 2022, interest rates have shot up from 0.08% to its current level of 5.33%, all in less than 2 years. But what does the inflation rate have to do with government debt? Well, the value of national debt in real terms decreases when inflation rises. National debt is often measured in nominal terms, meaning it is not adjusted for inflation. Inflation erodes the purchasing power of the dollar by reducing the value of money over time. When prices rise, each dollar buys fewer goods and services than it did before. This means that the same amount of money can buy less than it could previously, leading to a decrease in the real value of savings and income. For example, if the US owes $10 trillion and inflation rises by 10%, the real value of that debt drops because $10 trillion can now purchase only what $9 trillion could before the inflation. This effectively reduces the burden of the debt on the government. In addition, much of the US national debt comprises fixed interest rate securities, such as Treasury bonds. When inflation increases, the interest payments on these securities remain the same in nominal terms. However, because these payments are made with devalued dollars, the real cost of servicing the debt is reduced. While some may argue that the Fed's aggressive hiking of the interest rate over the last 2 years demonstrates its clear desire to get inflation fully under control, Rickards points out that despite these rate hikes, we have not been operating in a world of positive real rates. To illustrate this point, Rickards provides the following example. If inflation is at 9% and interest rates are at 2%, the real rate of interest is minus 7%. So even though the Fed has been increasing interest rates, the real rate of interest in the economy has still been negative, decreasing the burden on the government of interest payments in real terms. In addition to the benefits of both the value of the national debt and the size of interest rates being eroded as the purchasing power of the dollar falls, inflation also generally leads to higher nominal incomes, which can increase government tax revenues. As wages and prices rise, the government collects more in income and sales taxes without necessarily increasing tax rates. Higher tax revenues can help reduce budget deficits and the need to borrow more, indirectly lowering the debt burden over time. This additional revenue can also help the government service its debt obligations. And this is exactly what Rickard says is currently happening in the US economy. In his view, inflation is the easiest, quietest way to default on government debt, as it destroys the purchasing power of money. And since the creation of the Federal Reserve in 1913, up to 2023, the dollar has lost 95% of its value over that 110-year period. But you don't have to wait 110 years to see such erosion in the purchasing power of money. During the period 1977 to 1981 alone, the dollar lost over 50% of its purchasing power. And as Rickards demonstrates, at 10% inflation, you cut the value of the dollar in half in 7 years. Rickards argues that the Fed is deliberately managing inflation to erode the purchasing power of the dollar over time so as to reduce the value of the debt that it has outstanding and reduce the real cost of its interest payments on its debt. If you want to know how to protect your money during these scary economic times, click on this next video to get started. Thanks for watching, and until next time, keep building your wealthy life.